Thank you for that. It's a small world. The next presenter and I went to school together, and I don't think we've seen each other since school, so it's nice to see you. Thanks for having me. Thank you to Liana. Liana and I worked together for a long time and is at Cambridge now. So quickly, I'm John Khoury. I run Long Pond Capital. This is our 16th year in business. We focused on real estate and real estate-related securities. I'm going to focus today on a company called Healthpeak. The ticker is DOC, and it's a name that we hold in both products. Before I get into the individual name, I think it's important to set the framework of how unloved real estate is in the public markets. This chart just shows the performance of all subsectors or all GICs in the S&P from year-end 21 when rates started to go up. And as you can see, real estate as an asset class is the only subsector in the S&P that's still down. It's down 14%, has underperformed the S&P by 60%, and underperformed the next closest subsector by almost 30%. And so over that time period, REITs have clearly underperformed while they've grown earnings. And so the implied cash flow multiples or discounts to NAV have continued to deflate. And so today, the REIT space has gone from about 30 times cash flow to about 20 times cash flow since the end of 2021. In that framework, one of the worst performing companies in that space is a company that I'll talk about today called Healthpeak. Healthpeak is a healthcare real estate owner that owns three types of real estate. They own outpatient medical, life science, and senior housing. It's a $17 stock, $12 billion market cap, $22 billion enterprise value, and just north of a 7% dividend today. So at Long Pond, before we invest in a company, we really try to boil things down to four simple questions. Is a company cheap? It's kind of the most important place to start. And this company is cheap on any metric that one looks at. It's cheap to its net asset value. It's cheap to replacement cost. It's cheap to cash flow on an absolute and relative basis to other REITs. And as we'll walk through later, we think there's 60% upside over a 2-year period with very good downside protection. Why is it cheap? It's not uncommon when you're a REIT that owns more than one asset class. When one of your asset classes has a problem, it can deflate the valuation of the entire company, and we think that's what's happening here. Their 36% ownership in life science has been a weight across the entire company. Why will it cease to be cheap? We'll walk through a couple of catalysts. One's an IPO of a very successful business they have. Another is that we believe life science has bottomed and will start to grow again, which will lead this company to go from shrinking earnings the last 2 years to becoming an earnings grower again. And then finally, the downside protection while we wait. This is a 5 times levered company, great balance sheet, again, very cheap on all metrics, and a 7% dividend yield that we believe makes the passage of time beneficial for us. So the three asset classes that they have, outpatient medical, that's physicians' offices, diagnostic centers, day surgery. This is as bond-like with growth as a real estate asset class gets. It's a secular winner. It benefits from the aging of the population. There's a deep bid in both the public and private markets for this asset class today. Kayne Anderson just bought a $6 billion portfolio at a 6% implied cap rate from a company called Welltower. And there's a pure play company in this space called HR that trades in public REIT form that trades north of 15 times cash flow or almost 5 turns higher than Healthpeak does. The second asset class is lab or life science, which is the weight on the company today. That's where biotech, pharmaceutical, medical research gets done. It's very specialized, everything from HVAC to floor weights. So it's very specialized real estate, and it's a space where in the last few years, both supply went up a lot and demand went down a lot, which not surprisingly does not create a great cocktail for earnings growth, but we'll go through why we think that's changing. And then finally, senior housing, which is retirement homes for people 80 years and older. That's the hottest place in the real estate market today. Those are some of the fastest growing pure play REITs. And because of that, those pure play REITs trade anywhere from 30 to 40 times cash flow. And so that's a great business that's embedded within DOC. Quickly, just to show you what the stock has done in the last decade, it's basically been cut in half. Over that time period, its FFO or its AFFO multiple, which is the REIT proxy for free cash flow multiple, has also almost been cut in half. And then you can see versus other REITs, it's been even worse. So while REITs have underperformed, this has underperformed even more. And you can see on a relative basis, it's basically at its all-time lows relative to risk in the REIT space, which, as where I started, itself is fairly deflated today. In terms of valuation, on the left here we have the capitalization, which I ran through earlier, and then just the net asset value calculation. So putting the outpatient medical at about a 6% implied cap rate, which is where that Kayne Anderson portfolio, which we think is inferior to this portfolio, traded. Life science at an 8 cap, which is in line with where their public comp Alexandria trades, and we think they're much better positioned than Alexandria. And then a 7% implied cap rate on the senior housing. And we run that through the balance sheet, you get to a net asset value of almost $23 versus today's $17 price, or a 25% discount, or 33% up to NAV. And as I mentioned before, the balance sheet at 5 times levered is very conservative for an asset-laden business. And with the 7% dividend yield, we feel like the passage of time benefits us. Here, just to show some quick math of how cheap the life science portfolio is within this company. So instead of going through net asset value here, we go through the net asset value and then of everything but the life science portfolio. So taking out the outpatient medical at net asset value, taking out senior housing at net asset value, you see that the implied valuation of the life science portfolio today is north of a 17% implied cap rate, or about $300 a foot. And in comparison, the pure play company Alexandria, which again we think is inferiorly positioned today, trades at 2x that valuation, closer to an 8 cap and north of $600 a foot. So why do we think the security will benefit in the future? So clearly it's had a hard time getting to where it is today. There are 2 main catalysts. The first is this company's run by a smart person, it's a good capital allocator. They've got an incredible business embedded in here in their senior housing portfolio that trades effectively at 11 times cash flow. And so they've decided to IPO that business, which we think is very smart. We think that that business, once IPO'd, if it trades at 20 times cash flow, which would make it the lowest valued pure play senior housing company by about a factor of 8 turns, that would be worth day one, a 14% accretion or value to DOC. This is just an example of what their assets look like. On the top right, you can see the comp set trading anywhere from 28 to 39 times. What's interesting about this IPO, which we think is incredibly smart, is it will be listed with no leverage. And so without leverage, it gives this a company ability to continue to acquire on its own. And so through internal growth, or just charging more for the rooms that they have, and again, this is one of the hottest spaces in the real estate business, combined with levering up their balance sheet that's coming massively under levered, we think this will turn out to be one of the fastest growing REITs in the entire REIT market. So we think the 20 times number is very conservative, and we think there's optionality to the up for where this could trade. And then secondly, we think life science has done the terrible giving that it's had to do. And we think the industry itself is positioned well. DOC within that is actually positioned better. 60% of their portfolio is in South San Francisco, which we believe is the best market for life science today. It's the only major life science market that's actually started to have net absorption, or said differently, occupancy is actually starting to build, and we're 2 quarters into that. The other thing that they have is with their conservative balance sheet, and they're able to effectively take advantage of those who are forced sellers. So they've recently bought a $600 million portfolio from the company I referenced earlier, Alexandria, which itself is over-levered and a forced seller. And these assets are in DOC's backyard. So this is a 29-acre campus. Interestingly, they paid a 6% implied cap rate for this asset. They sold medical office buildings at a 6% implied cap rate to finance this asset. The only difference is the medical office buildings were basically at full occupancy, and this is 60% leased. If they can get it up to 80% leased, it becomes a 9% cap rate overnight, and we think there's a good chance that they'll get it much higher than that. So in the midst of this dislocation in the life science business, they're one of the few large players with a good balance sheet who's going to make accretive acquisitions that will bode well, we think, for the future as the space gets better. So with all that said, the return potential here is broken down into three components. Janus Living is the name of the IPO, again at 20 times. That creates, with a little bit of passage of time between now and the end of 27, that creates 19% upside. And again, we believe with optionality that could trade better. If the remaining company trades at 13 times, and the reason we believe it goes from 11 to 13 times is it goes from being a shrinker of cash flow to a grower of cash flow as this life science business starts to inflect and starts to grow again in 27. That's worth 30% upside. And then the powerful valuation or free cash flow yield at which we're buying the company helps along the way as they're using a good amount of that cash flow to pay us in the form of dividend. So 19 plus 30 plus 14 gets us to about 63% upside or a 28% IRR over a 2-year period. The big point I want to make about this slide, I mean, running through it quickly synthesizes everything I generally went over. The company is at a very cheap valuation. It has two, what we believe to be clear catalysts on the horizon that will lead to outperformance and significant upside. It's conservatively levered. It's very cheap on every metric. We're getting a lot of cash flow while we wait. And the thing that I think is important to highlight here is the asymmetry of this investment. Buying something as cheap as this company is at the current cash flow and at 11 times AFFO, assuming we're wrong on everything we think can happen on the upside, we think the asymmetry here is incredible. To have a potential 60% return with something that's as downside protected as DOC, we think is excellent asymmetry. And the last thing I'd point out is I do think this is riddled with continued optionality. If that 13 times cash flow that we're ascribing, every extra turn that gets, and to be clear, the REIT market itself trades at 20 times and grows 5%. We believe this will be going 3 to 4 and trading at 13. We think there's optionality there. And every one of those multiple turns in excess of what we're modeling is worth another 9% upside. So take a breather there.
Thanks, John. Let me start it off. REITs are heavily dependent on debt to finance acquisitions and development. We heard this morning that there's no longer any rate cuts planned or expected for this year. The cost of capital stays high. How does that affect your thesis here?
So that's really a good thing for a company like this. Given where they are levered today and given the liquidity of the outpatient or medical office portfolio that they have, they're in a position to play offense and make accretive acquisitions. If the debt markets get difficult, that's not really great for the forced sellers. That's not really great for the levered people. That's not great for the people with development pipelines they need to fund. If you've got a very liquid asset as your biggest asset, and in the case of Janus, the IPO, which has literally zero leverage day one, you've got an incredible ability to compete against anybody who has a leverage problem, a development problem, or any other need for capital when you're coming so conservatively levered as they are.
Take any questions from the audience?
Thank you. So what do you think about the outlook of occupancy? Thinking about baby boomers aging, people are living longer, but then we talk about the income gap. What do you think about that, and how does that impact your outlook here?
So the two asset classes that they have where they directly lease to individuals as opposed to companies are or where that benefit from an aging population are the medical office business and the senior housing business. The medical office building business is for the tenants, it's an incredibly affordable business. It's mission critical real estate. Without it, you can't operate your business. And with 2 to 3% rent growth embedded in these contracts, we feel very good about that growth. As it relates to senior housing, there's both occupancy gains and rental gains. Given what we're seeing in the silver tsunami or the aging of the population, combined with the lack of development in the space. So these companies are able to push rents because there's just a lot more demand that's affordable, and we've yet to see any meaningful supply. And the nice thing about real estate supply is these assets take years to develop. So the fact that there's no starts today mean that this supply-demand imbalance will last at least another few years. And then, should development start to catch up, development will only catch up if it's economic to develop, and it's only really economic to develop if rents go up a lot from where we are today.
Okay, thanks, John. I'm going to keep us on schedule, and we're going to move on to Justin. But, John, thanks a lot. We appreciate your time here.
Thank you very much.